Welcome to the Term Loans Walkthrough. Before we touch the pricer, let me set the scene. A term loan is a long-term mortgage on an investment property, typically 30 years. Unlike fix and flip or bridge, this isn't short-term money. This is the loan a borrower lives with for years while they collect rent on the property. Here's what used to make term loans confusing. We don't have just one term loan. We have three different programs underneath, each built for a different kind of borrower and a different kind of property. In the past, the broker had to guess which one their deal fit into. Not anymore. The Relip pricer figures it out for you. You enter the deal once. Our system tests it against all three programs at the same time, picks the one that gives the borrower the best structure, and shows you that as the default. The other two stay on screen, just collapsed, so you can compare anytime you want. By the end of this video, you'll know what those three programs are, when each one wins, and how to read the pricer screen like you've been doing this for years. Let's name the three programs. Program 1 is called 1 to 4 DSCR. DSCR is an acronym. It stands for Debt Service Coverage Ratio. All that means is, does the property's rent cover the mortgage payment? We'll come back to that in detail in a minute. 1 to 4 DSCR is for residential rental property, a single-family house, a townhouse, a condo, or a small 2 to 4 unit building, where the rent comfortably covers the loan payment. Program 2 is No Ratio Investor 1 to 4. Same residential property types as Program 1. The difference? There is no rent test. The deal qualifies on credit and down payment alone. You reach for this program when the rent doesn't quite cover the mortgage, or when the borrower's credit is too low for the DSCR program. Program 3 is Commercial Term. This is for bigger or more unusual properties, anything 5 units or larger, mixed-use buildings, think a coffee shop on the ground floor with apartments above, or pure commercial like office, retail, or warehouse. No rent test here either. That's it. 3 programs, 1 bubble on the pricer. Here's what happens when you fill in a deal on the pricer. You type in the basics: loan amount, property value, the borrower's credit score, what type of property it is. The moment any of that changes, our system fires off one calculation that tests the deal against all 3 programs at the same time. For each program, it answers 4 questions. Does the deal qualify at all? What's the maximum loan we can give? What would the monthly payment look like? And are there any red flags the lender would catch? Then it picks a winner. The pricer defaults to showing you the program with the best result for the borrower. The other 2 are right there, collapsed at the top of the screen. If you want to see what the second place program would have offered, maybe you want to compare leverage, maybe the borrower wants a lower payment instead of more loan, you just click to expand it. You never have to fill out the form twice. You never have to memorize which program goes with which kind of deal. The pricer handles the matching. Your job is to read the results. Let's walk through each program now, starting with 1 to 4 DSCR because it's the one you'll use most often. Remember, DSCR is the ratio that tells us whether the property's rent covers the mortgage payment. If rent equals mortgage, the DSCR is 1.0. If rent is higher than mortgage, the DSCR is above 1 and the property cash flows on its own. If rent is lower, the DSCR is below 1 and the borrower has to chip in every month from their own pocket. Here's how the pricer calculates it. We take the property's rent, whatever the current lease says, or if it's vacant, what the market would pay. Then we subtract the monthly expenses, property taxes, insurance, homeowner association dues, and property management. What's left is the net rent. We divide that by the monthly principal and interest payment on the new loan. That ratio is the DSCR. Now the rules. Minimum credit score is 660. If the borrower's score is below 660, the master pricer automatically sends the deal to No Ratio Investor instead. We'll get to that program in a minute. Minimum DSCR is 0.75. If the property's net rent doesn't cover at least 75% of the mortgage payment, the deal isn't eligible here. Between 0.75 and 1.0, it qualifies, but the rate goes up and the maximum loan comes down. To get the best terms, you want a DSCR of 1.0 or higher. Maximum loan to value is 80%. Loan to value, or LTV, is just the percentage of the property's price you're borrowing. 80% LTV means the borrower brings 20% as a down payment. To hit that 80% ceiling, the borrower needs a credit score of 740 or higher, a DSCR of 1.0 or better, and the loan needs to be under $1 million. As any of those soften, the maximum LTV steps down. The pricer shows you the live cap as you type. You don't have to memorize the matrix. Two more rules I want you to remember. If the borrower is refinancing and pulling money out of the property, what's called a cash out refinance, the cash they walk away with is capped at $500,000, no matter how big the loan is. And if their credit is below 720, the total loan size on a cash out is capped at $750,000, with no more than $100,000 of cash to the borrower. If the property is a short-term rental, an Airbnb or a VRBO, the borrower needs at least a 700 credit score, and the maximum LTV is 75% on a purchase, 70% on a refinance. Loan range is $100,000 to $3 million. Reserves, that's how many months of housing payments the borrower needs sitting in the bank at closing, are 6 months by default, 3 months for a clean low-leverage deal, 12 months if the loan is over 1.5 million or the DSCR is below 1. That's 1 to 4 DSCR. The first program the engine tries on any residential rental. Now, what do you do when the first program doesn't fit? That's where no ratio investor comes in. No ratio covers the same property types, single family, condo, townhome, 2 to 4 unit, but it skips the rent test entirely. The deal qualifies on credit score and down payment alone. You'll reach for this program in 3 situations. First, the rent doesn't cover the mortgage. Maybe the property is vacant. Maybe rent comps are weak. Maybe the borrower is paying above market. Whatever the reason, if DSCR isn't going to pencil, no ratio keeps the deal alive. Second, the borrower's credit is below 660. The DSCR program won't accept the credit, but this one will. In fact, it'll accept credit all the way down to 500. The old program some of you may have known as Credit Flex has been folded into the bottom of this credit ladder. It's the same program now. Third, the rent picture is messy. No lease yet, appraiser keeps changing the rent estimate, that kind of thing. No ratio takes rent out of the equation, so you don't have a moving target at underwriting. The trade-off for skipping the rent test is a tighter LTV. Baseline is 75% on a purchase. But here's the part that catches brokers off guard. For credit scores below 660, there's a step-down ladder. Between 625 and 649, the cap drops to 70%. Between 600 and 624, it's 65. Below 600, it's 50. So a borrower with a 580 credit score can still close, but they're bringing half the deal in cash. A few more caps to know. Any loan over $1 million caps at 70% regardless of credit. Foreign nationals, borrowers without a U.S. Social Security number, cap at 65%. And first-time investors, borrowers who've never owned an investment property before, take a 5-point reduction off whatever LTV they'd otherwise qualify for. Loan range is $75,000 to $2 million. The bottom line on no ratio: you give up some leverage, you give up some rate. In exchange, you skip the rent test and you can close credit scores most other lenders won't touch. For a borrower whose deal won't pencil any other way, this is the program that gets them home. The third and last program is commercial term. It exists because the first two only cover residential, 1 to 4 unit properties. Anything bigger or unusual goes here. 3 things send a deal to commercial term. Any one of them is enough. 1. 5 or more unit multifamily, a building with 5 or more apartments. The minute you cross from a 4 unit to a 5 unit, you're out of residential and into commercial. 2. Mixed use. The classic example is the coffee shop with apartments above. As long as any part of the building is commercial, the whole thing routes here. 3. Pure commercial. Office buildings, retail strips, warehouses, self-storage facilities, automotive properties. None of that fits in a residential program. Like no ratio, there's no rent test. You qualify on property type, credit, and down payment. The rules. Minimum credit score is 500, same as no ratio, and the same sub 660 credit ladder applies. 70, 65, 50 as you step down. The maximum LTV depends on what the building actually is. For 5+ unit multifamily and mixed use, the max is 75%. For pure commercial, it's 70%. Loans over $1 million drop the cap to 70 across the board. Foreign nationals cap at 65. First-time investors take that same 5-point reduction. Loan range is the widest of any program in the pricer, 100,000 to 5 million. If a broker pulls up a 12-unit apartment building or a strip mall retail deal on the pricer, commercial term is the only one of our 3 programs that returns eligible. The other 2 flag a property type rejection, and they'll tell you exactly why. A few things are true no matter which program wins. The loan term is 30 years, fully amortizing, meaning the payment includes principal and interest, and by year 30, the loan is paid off. Most rate options have an interest-only period available, 5, 7, or 10 years, where the borrower pays just interest and the principal balance stays flat. That's useful for maximizing cash flow in the early years. The prepayment penalty defaults to a 5-year declining schedule, 5% in year 1, 4% in year 2, then 3, 2, 1 in years 3 through 5, and nothing after that. Brokers can buy down a year of prepay for about 3/8 of a point in cost. Most programs require at least 1 year of prepay protection. The borrower closes in a business entity, an LLC, a limited partnership, or a corporation registered in the United States. Members who own 51% or more of that entity personally guarantee the loan. That's the same on every program we offer, not just term. If there's a second mortgage on the property, the combined LTV across both loans caps at 90%. This only applies to the no-ratio programs. And finally, maximum broker compensation is 5% of the loan amount, including all fees combined. You don't actually have to do this. The master pricer picks for you, but knowing the logic makes you sound like a pro on the phone. 4 questions in order. Question 1. Is the property 5+ units, mixed use, or pure commercial? If yes, the answer is commercial term. The other 2 programs reject those property types. Question 2. If it's a 1 to 4 unit residential property, is the borrower's credit below 660? If yes, the answer is no ratio investor. The DSCR program won't accept the credit. Question 3. Credit is 660 or higher and the rent covers the mortgage at 0.75 or better? The answer is 1 to 4 DSCR. This is the rate and leverage winner. Question 4. Credit is 660 or higher, but the rent doesn't cover the mortgage, or the rent picture is too uncertain to trust. The answer is no ratio investor. You trade some leverage for a cleaner underwrite. That's the whole decision tree. 3 programs, 1 bubble on the pricer, 1 engine that picks for you. The pricer always defaults to the best structure based on what you typed in. The alternatives are always 1 click away. 3 programs, 1 pricer. You're done. See you in the bridge video.